Welcome to Pressure Points. Our topic is Tesla earnings, and they're going to be reporting on October 22nd. And just taking a step back, the big picture here is over the past 3 months, Tesla stock has done well, up just over 30%. The Nasdaq's up 8%. And during that period, we've had a positive delivery number that is largely thought of as kind of one-time in nature and not a ton of updates related to how things in Austin and San Francisco and other markets have been on the Robo taxi and Optimus front. And so when we put all that together, the stock continues to look forward into the future, 26, 27, and 28 for this market cap expansion. And I want to kind of start there and just in terms of kind of the raw numbers and maybe lead with this bad news category related to this transition period that the company has described that we're in. And when I hear transition period, I hear less visibility. And I want to give some perspective in terms of what the numbers look like and the visibility in the numbers, at least on the delivery front. So they just reported 7%, just over 7% delivery growth in the September quarter. That, of course, was promoted by the tax credit ending. But the expectation, at least the FactSet number for the December quarter is down 6%. Now, I caution that that number is basically 52 analysts, and only a smaller set of those analysts actually keep up to date with their numbers. And so if you look at those numbers who have been more active in terms of making adjustments, for example, after the last delivery numbers, they're looking for more like down 10% in the December quarter, which would kind of suggest that's where the whisper number is at. As far as next year, they're not going to give like an explicit delivery growth target, but I suspect that they'll say they expect deliveries to be up, flat, or down, some language around that. Currently, the FactSet numbers are plus 15%. Now, I think that the whisper numbers are more like plus 5 or plus 10%, but the plus 15 is where the in-print numbers lie. And my sense is that that number is heavily dependent on how you would answer this next question. And that question is, has Tesla already rolled out their more affordable model? If the answer is no, they haven't, and they're still going to roll out a more affordable model at the end of this year, and it's going to ramp next year, then I think it's reasonable to expect 5, 10, 15% delivery growth for next year. If your answer is that the lower price Model Y is that vehicle, then you start thinking about flattish numbers for next year. I'm currently in the camp, I seem to evolve week to week, but currently in the camp that the cheaper Model Y is in fact that more affordable vehicle. And that's based in part on what they said on the last earnings call, specifically is that this new vehicle would not be negative to margins and that it would be ramping at the end of this year, in production at the end of this year. And so to roll out a new model that's in production, that's not negative to margins, it almost would have to be something that is already in motion, something that has some history to it. And so that's why I think that this lower price Model Y is in fact a more affordable vehicle. And based on that, it's definitely a move in the right direction. I think it supports Tesla being flat, maybe up a little bit for next year, but probably isn't going to support a 15% growth number. And so I would just caution that maybe some commentary, if that ends up being the case, may end up weighing a little bit on shares. I did do a poll on X. After the new Model Y came out, 60% of people said that they believe that that new Model Y is still in the works. It's not, the more affordable model is still in the works and yet to come. 40% say that it was that. So it seems like people are generally pretty split on how that plays out. Overall, I would expect that the revenue numbers for next year, I'm still talking about this being a transition period, to probably go down for next year after post earnings. But of course, that is largely window dressing when it comes to the Tesla conversation because it's about autonomy. And I'm going to start talking about any updates from the robotaxi side. Of course, Tesla, San Francisco, we don't know how many vehicles are there, but it doesn't seem like it's been expanding. The number of invites has not been expanding that much. Generally, the thinking is there's probably 50 vehicles on the road. That was a similar number as a couple months ago. The geofence has expanded a couple times now, more comparable to where Waymo is, but is we don't hear about big changes to the geofence outside of that in Austin. And so I think it's safe to say there has not been a lot of updates related to Austin. The company has talked about coming into a couple new markets at the end of this year. That would be Phoenix and Las Vegas, November, December timeframe, and 20 to 23 U.S. metros planned by the end of the year, pending approval. And of course, the pending approval is the get out of jail free card. Like, as long as it's pending approval, it's who's to say what happens there. But I think that any commentary around how that's progressing, of course, people are going to be very keenly listening to. And so overall, what Elon said on the last call, I'm going to read you his quote regarding the robotaxi rollout. He said that the robotaxi fleet will go from tiny to gigantic in terms of operations in a pretty short period of time. Like, my guess is that it has a material impact on our financials around the end of next year. We'll continue to expand outside of Austin. So tiny to gigantic, end of next year. Now, end of next year is actually a definitive time frame. And so the tiny to gigantic wasn't very clear, but end of next year. So they still, if you just hold them to the letter of the law of what they said in the June earnings call, they still have time to say Austin is going to ramp next year, and they could credibly come back and say, well, we never really told you it was going to ramp that much significantly before that. So they have some room around that, but I just want everybody's bearings to be on the same page in terms of what to expect and what that commentary means. Next, related to kind of the autonomous opportunity, is the unsupervised FSD for personal use. Now, this came up on the last call. This was the first time on the last call where Elon talked about being paranoid. And he said that it will be available for unsupervised personnel by the end of this year in certain geographies. So it's a pretty clear bar. That bar has been set many times before, and they have not achieved it. My general sense is it doesn't really matter what he says about unsupervised FSD. Most people are hyper-focused on the robotaxi opportunity and not focused as much on FSD. As far as non-Tesla owners contributing their vehicles to robotaxi network, last quarter, Elon said sometime next year. He said, as I mentioned, I'm paranoid about this safety thing. And I think this paranoid on safety thing is a relatively new phenomenon that he's talked about. It was new in the last earnings call, and I think it comes from some of the number of interventions that they have had in Austin has been greater than what they had expected. And so understandable that that is his message. And I think they'll probably continue on that message. But he did say non-Teslas into the robotaxi network in the next year. And kind of the last piece in the autonomy conversation is around Optimus. This is, the big X factor to assuming Elon gets his pay package approved on November 2nd at the shareholder meeting. Optimus is going to be one of the biggest X factors to that. And he said last quarter we'll have a bunch of Optimus robots on stage at the shareholder meeting, that being November 6th. And I'd be surprised if at the end of 5 years and 60 months from now, if we're not roughly making 100,000 Optimus robots a month. He says, I would be shocked. So 5 years out, I mean, that's so far out there. I mean, he's basically saying, don't put too much into Optimus right now. I think that investors generally aren't. If we pull all the autonomy pieces together, whether it is the robotaxi network, whether it's FSD, whether it's Optimus, put all those and kind of put it all together, I think what matters most is commentary about how Austin is going and how fast they're going to be rolling out new markets in the US. That's probably going to be the biggest determinant in terms of how Tesla shares trade shortly after their earnings. So those are the pressure points. I do want to end with one postscript related to the regulatory credit business. Now, this falls well below the fold into the postscript section because typically investors have dismissed this as any sort of ongoing credible part of their business. It is a large amount. It can be up to 40% of net income in a given quarter. After the June quarter, they had written down their expected revenue, the expected income that they were going to get from these tax credits, basically all income. And they had written that down from just over $4 billion to $3.5 billion because of some changes in the regulatory environment. This has nothing to do with the consumer tax credit that we saw ending at the end of September. This is about traditional automotive not hitting their mileage thresholds, and they have to essentially pay a penalty for doing that via these tax credits. My sense is that this tax credit pool, this 3.5, gets skinny down and ends up being a much smaller number in the future. I don't think it really matters. Yes, Tesla's multiple is going to go up because that could go up by 20, 30%. I don't think anybody cares because it's not a really core part of their business. Final piece, the energy business doing great. It's up 50, 60% for 3 quarters in a row, then down 10%. It's 15% of revenue. It's starting to become more material, but I think it still falls well below the fold in terms of what people are focused on this earnings period. On behalf of Pressure Points, I'm Gene, and we'll see you on October 22nd.